Hello and welcome at Value Investing, where we try to estimate the intrinsic value of different companies. First of all, I would like to mention that this is no investment advice, this is just my own opinion. In today's video, we will have a look at CVS Health Corporation, which is a company in the healthcare sector with three different income pillars. Today, the stock is down around 24%, and year to date, it is down around 27%. So if you do not know this company, let's have a look at their different pillars of income. So their core business was pharmacy, so CVS Pharmacy and CVS Caremark. And also with the latest acquisition of Aetna, they have an income stream over an health insurance company. And very recently they acquired two different companies for advanced primary care, that is Oak Street Health, and also a home health provider, which is Signify Health. As usual, we will hop into the valuation with four different valuation models. If you have a look at CVS, the price is down quite a bit over the last few years. And also the earnings per share had a very difficult time if we have a look here. So they grew up to $6.44 and then had even a year with negative EPS and then would ramp it back up. Currently the dividend yield is around 3.5%, which is kind of nice. But keep in mind, they have a lot of debt due to their latest acquisitions. Let's now start with Graham's valuation, where we use the revised formula from Benjamin Graham. And usually I like to use the historic value for the earnings per share for this estimation. However, I do think here we should make an exception and use the prediction of the management due to their latest acquisition of Signify Health and Oak Street Health, as they will boost the earnings per share quite a bit. So here we can see their adjusted EPS estimate from the management is 8.5 to 8.7. So we will use 8.5 as an estimate looking forward. I've plugged all the values in with a growth rate projection of 4.5% and the current yield of AAA corporate bonds, which brings us to an intrinsic value of $93. Let's go to the multiples valuation, where we compare CVS with different companies. I have used DGX, LH, United Healthcare Group and also the Cigna Group as a comparable company. I would also like to use Walgreens, but they currently have negative EPS, which would drive down the intrinsic value too much, and I do not think it's a fair comparison if you compare it to companies with negative EPS. So I've plugged in all the values here, and which brings us to a price earning multiple, or at least the mean is around 20 and also the average is around 19. If we use the historic EPS from CVS with 3, we get an intrinsic value of around $56. The discounted cash flow analysis considers the free cash flow, so the historic free cash flow of this company, and analysts also project a negative growth rate for the next few years, which I have adopted in my calculation and have calculated the future free cash flow and the present value of the future free cash flow with a negative growth rate projection. Considering the amount of total debt they have currently, which is kind of high due to the latest acquisitions, we get to an intrinsic value of around $119, which is quite higher than the current trading price. And now let's have a look at the dividend discount model, where we consider the dividend payout and also the increased dividend payout, and we can see that they have increased the dividend payout quite a bit, or at least didn't lower it. Growth rate of around 0 for several years. The average growth rate for this company is around 9.5%, but I have projected a growth rate of around 4.5, which brings us to an intrinsic value of 76. Please also keep in mind that this company is buying back shares usually. So we can see they have increased their shares in 2005, 2007. But they consistently kept buying back the shares. And with the latest acquisitions of the said company and also Aetna, they had to increase the outstanding shares, but also the management statement is to buy back shares, and they also did it recently in 2023. So we can see the outstanding shares are decreasing, and that's also very friendly from the management towards the shareholders as they keep increasing the value of the company. So let's get back to our valuation. Considering all four valuations, we have Graham's valuation at 93, discounted cash flow at 119, dividend discount model at 76, and multiples valuation at 56. We get an intrinsic value of around $86. And if we want to apply a 20% margin of safety, we get an acceptable buy price of $69, which is higher than the current trading price, which makes it a buy. I would be interested what you think about this company. Please leave a comment down below, and also keep in mind this is no investment advice, this is just my personal opinion about this company.